Everyone. This is the March 2023 ClearVista Financial Perspectives update for the market and so forth. I'm your host, Mark Trice, financial advisor, and of course, I'm joined as always by fellow financial advisor Jesse Hamilton.
Hey everyone, welcome to the webinar.
So a number of different things that we're going to cover, but we're going to go over the indexes. February was a testing of the potential strength of the market, and of course that test rolled over and didn't do quite as well as we had hoped to. We'll talk about things that are going on in the markets and so forth. We'll also talk about the economy a little bit, and then we will answer any questions you may have or anything like that. You can put those questions in the question box on today's webinar, and we'll be happy to open those up and talk about them.
So we'll start off with a little laugh right here. Mark found this the other day.
Yeah, we always find cartoons about the market and stuff. Let's go ahead and minimize or turn off our camera, Jesse, so that people can see more of the screen there. We think that the market's turning around and it's formed a bottom, and that everything is over with, and then it isn't. And so anyway, let's go ahead and jump in.
All right. So we'll start with our index performance. The first one that we cover is the S&P 500, which is the large cap stocks in the United States. This is cap weighted index, and it's the one that you probably see on the news, but that index was down 2.62% for the month of February. You can see this chart here is what we call a candle chart. Green days are up days and red days are down days. This index is up 3.39% year to date, but you can see in the last week we've had some pretty serious weakness and a lot of indecision in the market over the past few days.
Well, and January was a strong month for all the indices and so forth, even commodities and things of that nature.
Right.
All those tended to roll over in February. In fact, from the peak on the first couple of days of February down to the close, the S&P rolled over about 6%. So there was a significant pullback there within the S&P 500 during the month of February. So we broke out. That was a big key indication that we follow to reinvest part of our client capital and so forth. That fell and failed. That test failed, and we've got support now at right around 39.42, and that's what the market in the last week has been bumping along here. So I think that's not bad news. It just means that we have temporary rollover. I do think that we're still seeing that the market is forming a bottom. Whether or not we test the lows of October still remains to be seen, but I'm pretty confident that we're starting to see the formation of a bottom and hopefully a rebound in the stock markets.
Right, and we'll cover exactly what happened economic-wise later on. Here's the NASDAQ index, which is the tech-heavy sector. You've probably heard a lot of these companies that we use every day. Minus 1.13% on the month, plus 9.43% year to date. A lot of these companies are going to be sensitive to the interest rate environment, and they tend to be pretty volatile, right?
They do, and so there was a quick run up in the month of January. We fell off in February. I think from the peak in early February to the end was something like almost a 7% decline for the NASDAQ.
Right.
As Jesse said, the NASDAQ is very sensitive to interest rate hikes. In February, the Federal Reserve raised overnight Fed funds rate to about 0.25%, and that was expected. They'll be meeting here in a week or so, and there's some talk that they're going to raise interest rates even more. That will be kind of a drag on especially companies within the NASDAQ.
Right. So next we'll cover the Russell 2000, which is our small cap companies. These are smaller publicly traded companies, and you might hold some of these in your portfolio, you might not. But that index was down 1.72% for the month of February at the close, and it's up 7.93% year to date. This can tend to be a little bit of a leading indicator, but not always.
Usually the Russell 2000 index is focusing on small cap companies, smaller companies. When we see true breadth in the market, we see the Russell 2000 kind of be leading in that charge, if you will. Similar to the S&P and to the NASDAQ, the Russell 2000 rolled over about 6% or so from the peak in February early on to the end of that month. So we're looking for this health right now. Small caps seem to be stabilizing a little bit. We'll see what happens in the coming weeks, especially once the Federal Reserve kind of gives its forecast. And that's something we'll talk about in just a minute.
Right. So next we'll talk about the long-term Treasury bond index. This historically has been a safe place for what the buy and hold investor might do, but over the past month in February, it was actually down 5.09%. It's slightly positive for the year to date, and I'll draw a little marker here. There's this candle right here on February 2nd. The index touched the 200-day moving average, which is a key technical indicator, and then it fell over again.
Yeah, and we saw that fall. We knew that was going to be an area of resistance. We didn't think it would pull back so much. I think that was down over 7% or so during the month from that high. And we're going to be watching this, and we'll talk about this more about interest rates in just a moment and how they impact the bond market.
Right.
All right, so let's go back and look at the S&P for the last several months.
So as always, this is ClearVista Financial Perspective. So we like to show a longer term perspective. This shows the last 6 months of the S&P 500, including the August high and the October low at the end of last year. And you can notice some consolidation patterns through the end of 2022. The August 16th peak to the February 28th close there at the end of the chart was minus 8.24, just for some perspective there. And January saw a rise, you can see on the chart, and then the price failed to stay above the 200-day moving average.
And we think it's important here to focus on how we think that the stock market is forming a bottom a little bit. This is a normal pattern within a bear market. Now, we don't have the full year of 22 on here, but we know that the S&P was down about 20%. NASDAQ was down almost 30, and then long-term treasuries were down almost 30 as well, 30%. And we see these normal patterns. What we don't believe here is that we will test the October lows. Jesse's going to kind of circle or show that for you. That's where the bottom of the market is. We don't think we're going to go back down to there. We will know if we see that the market starts pulling back and goes below the December lows, which was a rapid sell-off in December. But if it goes below that, then I think we're likely to test those October lows. But right now, we kind of see things in a consolidation pattern. We're seeing, and that's strong because it means that the market's building a solid base for which to grow off of. Okay, so let's jump on in to the economic update. Okay.
So we're going to cover the Treasury yield first, Mark, if you want to go for that.
Yeah, so there's been a lot of talk lately about the inverted yield curve. Now, this is the yield curve, and what it's showing you is the interest being paid on different types of bond maturities. And in a healthy economy, we would see that the yield curve would look something like a hockey stick. And it would, Jesse's going to try to draw on here, if he can, what that might look like in a healthy economy. So interest rates are low, and then on the far end of the spectrum, on the 20 and 30-year treasuries, those are going to be higher. But we're seeing that that's the opposite. Now, this is traditionally, when we see this inverted yield curve like this, it is a fairly strong leading indicator signaling a recession. Now, recession sounds like a bad word, but it may not be in this situation. And the reason is because we have a lot of strength in different areas, which we'll cover in a second. But here you can see that the 6-month yield is over 5%. That's why you're starting to see savings account, maybe some short-term CDs are starting to pay a little bit higher annual percentage interest rates, okay? We think that this will fall in the coming months. It may be towards the end of 2023 or maybe the beginning of 2024, but we think we'll see this begin to invert. Now, just for a note, the 10-year treasury, circle that one, Jesse, just so people can see that. That 10-year treasury right here, oops, we did it again.
Sorry. Here's the 10-year treasury.
So right in here, that 10-year treasury rate was below about 3.8%. In just the last few days, we don't have it on this chart, but in the last few days, it crossed above 4%. Now, that's significant. because we're seeing interest rates rise again, and we expect them to continue to rise on the long-term end of the spectrum here. But these are the things that dictate the price of a mortgage, what you pay in financing for a new car, and things like that. So we're seeing that break out, and that is broken above a pretty critical area there that we have to watch. And so that's not as positive when we see those rates going up, because the impact can be that the economy is slowing down. So let's talk about this, because this is one of the things that the Federal Reserve is looking at. The January jobs report came out after our last financial perspectives update in early February, and it was reported in the month of January that the U.S. added about 517,000 jobs. Now, normally this would be exciting news, right? Because it shows a strong economy, a healthy economy, and so forth.
Exactly.
Except that the estimates were supposed to be around $188,000, and unemployment hit a 53-year low at 3.4%.
So why is this a bad thing?
Well, the problem is this is one of the key data points that the Federal Reserve is looking at in their efforts to try to fight inflation. So this print of the jobs report was way too hot for the Federal Reserve. And so this is why I think they're likely to raise interest rates at their next meeting in March.
Yeah.
Up another 0.5 percentage point. Okay, so it's when good news is bad news, right? Is not when we're trying to fight inflation. We're seeing inflation, and so those yields ticked up again when they raised interest rates in February. So this is kind of impacting the stock market. It's kind of dragging on this. The Federal Reserve wants to cool demand, but you'll see in the next slide here that we still are spending. Prices are still rising. So the consumer price index, this is what we use to measure inflation. And that re-accelerated in January. In December, I think it was 0, wasn't it? Or 0.1, a very small number. And then in January, it ticked up again.
This is just a basket of common goods, right?
That's
services that people buy.
Cars, goods and services, healthcare, utilities and energy prices and things like that. And we also saw the price at the gas pump go up as well.
Right.
So all those things are adding to those things. So that is one thing that we're looking at, that prices are still going up. Jesse, I talked to a friend the other day, he lives in Seattle, and he said he's paying $10 per carton of eggs.
No way.
$10. And I said, no, you're crazy. I'm gonna go look. I'm gonna get on the HEB website and see what it costs for a dozen eggs here. And he's right. Now in Seattle they pay more for everything because of all the different taxes and stuff. But a carton of eggs for grade A large eggs was like $7. And so you're still seeing those prices go up at the grocery store. We don't think that's going to be cooling off anytime soon. And in fact, we think that that inflation will still continue to be sticky. All right. If you looked at that inflation rate, you're looking at that's well over a 5 or 6% annualized rate if that continues on. Another thing that's going on is the retail sales surged in January as well. Now this beat the expectations, and it's the fastest gain for any month in almost 2 years, Jesse. And so this is really concerning when it comes to inflation. Once again, we've talked about two different things that are really good economic news.
They are,
right?
People are spending money.
That's right, but they're bad for fighting inflation. So, that's the thing that's on the mind of the Federal Reserve. And so we believe that they're going to continue to tighten monetary policy since, like they've done the last year. Now, you have to remember here with all these things is that the rise in interest rates last year was unprecedented.
Right.
We have, with the exception of maybe 1993, and that was a year that interest rates got hiked a lot during then to try to cool the economy off. And of course, we had a little minor recession around that time. But these are things we have to remember. Last year, that this was a very aggressive increase in interest rates to cool inflation. And that has an impact on all your bond portfolios. That's why last year we held next to no bonds in our client portfolios. because that resulted in a dramatic decline. I think I've talked
Right.
about this on other webinars before, but last year at one point, the long-term Treasury bond was down almost 40%.
Wow.
And that's huge. And that in fact, that hasn't happened in that way where we've had stocks down by more than 10% and bonds down by more than 10%. That's happened only one other time other than last year.
Yeah.
And it was well before any of us were born, and our listeners were born, as during the Great Depression in 1931.
Yeah. And we covered last month about how people's savings are getting smaller and smaller. So this increase in retail sales is just not sustainable for Americans as their savings continue to drop.
Yeah, we're seeing debts rise. We're seeing saving levels drop. And we're getting through all the COVID stimulus, which, by the way, is one of the main reasons we've got this problem with inflation.
Right.
We printed so much money and passed it out to everybody.
So let's talk about home prices real quick.
Yeah, so the home price growth decelerated again in 2022, partly due because of the rapid rise in mortgage interest rates. I mean, we went from being able to get a 30-year mortgage at 2.5 to 2.7%. To now having to pay close to 6 or 7% on that same mortgage. That dramatically impacts affordability.
Right. And it is slightly down, but they're still very high.
Yeah. And so we're seeing this cool off a little bit. I think I've already seen some data for February where it dropped even further. When we go back to that 10-year Treasury rate we talked about, that will have an even more of an impact on home sales.
Right.
Okay, so what does all this mean? All right, well, the markets are going to continue to be a little bit bumpy, and they're going to react to what Jerome Powell and the Federal Reserve members say this month when it comes to inflation. One of the things that we're looking for at their next meeting is, and we should have put this on the slide, is the dot plot. Now this is where Jesse and I will have a little bit of a nerdy geek out here.
Right.
On dot plots and things.
It's basically what everybody thinks is going to happen.
Right. All the Federal Reserve presidents, the regional presidents, will forecast out for the next quarter, next several quarters, even on into 2025, about what they think the Federal Reserve overnight Fed funds rate will be. And we'll see, do they think that inflation is going to be sticky? I think it is, because I think our policymakers are probably doing the wrong things to help fight this. But instead, Washington just wants to keep printing money with more and more spending bills. So, things that you should think about are, make sure that you're having a review with your financial advisor. If you don't have one, we'll talk to you about that. But you need to educate yourself about what's going on. A lot of people were concerned that their portfolio was down last year, and it was. But look at your portfolio performance relative to the overall markets. You may be surprised as to what you're doing. If you're one of our clients, you already know this. But it's important, if you're not a client, that you look at that and give your financial advisor a call to talk about your specific plan. What we're telling people, and a lot of people have forgotten that a bear market is a normal recurring thing that happens every 4 to 5 years on average.
And we were overdue for it.
That's right. And so we haven't had one in 13 years. And so this is something that you should be putting into perspective. Let's see if we've got any questions on the board, Jesse. With that, just go to the question thing there, and you can put the camera back on if you want.
Okay. I'll put the camera back on here.
And it doesn't look like we've got any questions on the board right now. That's fine. But if you want to contact us, you can give us a call at our office or shoot us an email if you'd like to visit about your particular situation and how, what you should be doing with your portfolio. So anyway, seeing there's no other questions and things, we're going to go ahead and wrap it up for today. If you're a client, you will get a copy of this recording coming up in a few weeks in our mid-month email that we send out to all clients. If you have any questions, feel free to give us a call. We're watching everything as we normally do, but we're here to serve you. And if you have questions, go ahead and contact us, and we'll be happy to visit with you. All right. Thanks. Have a great day, and we'll see you next month.